Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Optimism over a US-China trade deal pushing bond yields higher. The move comes as investors price in another rate cut later this week. Greg Peters of PGIM Fixed Income writing the following. Near-term dynamics remain challenging, policy-sensitive and under fiscal stress, which may add pressure on rates. Greg joins us now for more. Greg, welcome back. Do you think supply issues might reassert themselves as a problem in the coming months?
I don't think supply is so much a problem in the coming months, but I think next year is a very different supply story. But I think the bigger issue is, you saw it in the CPI release, is that you are seeing inflation pressures away from rents and OER, right? And I expect that to continue into next year. And what I really worry about is that investors are very much of the mind the Fed's going to continue to cut. Inflation is, a 2021 story, largely contended with, and I think the risk is you're cutting into a higher growth, higher inflation environment, and the question is, what does the bond market think about that ultimately?
So, Greg, your point's interesting because this market took comfort from what was happening with shelter, but you're taking anxiety from what happens everywhere else. Greg, do you think the market's going to come around to your point of view, and why?
Well, so I think the shelter component, what has been an incredible disinflationary driver this year, and that's actually given kind of the broad CPI or disinflation numbers cover, right? But as we go into next year, you'll have continued pressure around those goods, particularly those, affected by tariffs. And, this is a story that's leaking out over time. This is not a one-shot type of idea. And so next year you have shelter either flattening out or even maybe moving higher. And that just changes the game, I think. And I think that is underappreciated.
Right now, I'm looking at break-even rates that are at the lowest levels going back to earlier this year. I'm looking at inflation expectations over the longer term. It's just falling significantly over the past couple of months. Why do you think that is? I mean, why do you think the market so profoundly disagrees with this higher inflation, higher growth view, at least based on market measurements?
I don't know. That is something that really confounds me, honestly. When I think about, next year, that is the most central figure that I look at. So it has a twofold effect. Number one, obviously, it's a markets measure around longer term inflation, but also there's lots of talk around the Fed, what happens with the Lisa Cook case, what happens with the new Fed chair, what happens to the kind of the path of rates. Are we really moving to this really easy type of environment? And if the market starts to get spooked around that, that's going to manifest itself not only in the US dollar, but in five-year break even. So I look at that and I do scratch my head. And for my money, that is something that I'm kind of looking the other way. What I think it should be higher, not lower.
How much are you actually betting against some of these longer dated bonds? I mean, right now we're looking at a corporate sector that's in pretty good shape. You can make the argument that you should get tighter spreads. And at the same time, when you look at the government bond market, there's a sort of mystery wrapped in an enigma about inflation and why it's not being priced in more. How actively, aggressively are you betting against where things are now?
Well, what makes it incredibly tricky is just the uncertainty component around not only tariffs, right? We have a Supreme court case that's coming due. What happens, after that? Well, and then there's lots of worries, I guess, around changes in issuance, changes in buybacks, and so investors are a little leery to lean too much into the curve steepener and the back end of the curve in particular, just because you can see that change in dynamics that could kind of catch investors by surprise. So I think there's a tentative nature around it. So I see it more cleanly, from 2s, 10s and that part of the curve. As you go further out, you're more exposed to these certain vagaries.
Greg, that's the Treasury market, and we've touched on the supply there. We'll get tons this week. Let's talk about the corporate supply that's coming this week as well, and what it's financing. Greg, Is this market still wide open for this kind of debt issuance to finance the capex stories that we've been talking about in the media every single day?
It is for now. So there's just a tremendous amount. I start to scratch my head, as you go out the curve, particularly on the unsecured side. So there's been some deals in the marketplace that really don't make a lot of sense to me necessarily. But this is a tremendous build out. There's a tremendous amount of circularity around it. So this is, something that I think makes sense today. But as we go through this cycle, I worry about the refinancing aspect, and ultimately the AI adoption and the return on investment that these companies need in order to make sense, and that's what starts to worry me. But as of right now, Jonathan, the markets are open. Everyone's all in on the AI trade, both sides of the debt and equity aisle. But at some point, there has to be a return on that invested capital, we shall see.
Well, Greg, with that in mind, how closely does someone like you watch the earnings as they come in on Wednesday, on Thursday?
Yeah, so I think earnings are incredibly important here. We have these long-term structural issues that we worry about, but honestly, from an investor standpoint, right, you worry about the cash flows and the earnings in the here and now. So I think it's crucial to kind of keep this market afloat. As long as you see, a pretty reasonably strong corporate environment and backdrop, I don't really see this bull market changing, anytime soon. So it's about the near-term data that's allowing investors to kind of look past maybe some of the longer term structural issues that we talked about, namely Fed independence and, some other areas.
Stay with us. More Bloomberg surveillance coming up after this. Got to talk about this market and the amount of M&A activity we've seen over the summer and into the end of the year. Over $900 billion in deals completed so far this year, with another $1.1 trillion in the works, on pace for a 59% rise from a year ago. Vito Sperduto of RBC Capital Markets US writing, the market tone has shifted from waiting for an optimal window to moving into execution mode. More discussions of large deals, more preparation, more momentum. Vito joins us now for more. Vito, good morning.
Good morning. Good to be here.
Well, we spoke only recently. Are things picking up even more over the past few weeks?
I just think about the past. I was here at the beginning of the month, and just the tone, as was just talked about, has clearly shifted. We've gone from trying to time the right window, and we always talk to clients about the importance of being prepared to execute on your strategic initiatives and being prepared to access the window when it opens. Well, the window feels open, and I think we're into full execution mode with many of our clients.
Could you give us a sense of how much it's accelerating?
Just to give you a sense, in this past couple of weeks, the volume year to date, both from a global perspective and from a U.S. perspective, has exceeded full year last year. So just to kind of, and we've also seen where total volume was up about 28 to 30% globally and U.S.-wise at the end of the third quarter. We're now talking about up 35 to 38%. We've seen some larger deals announced, especially across the technology space, the healthcare space. But more importantly, we've also seen the tone of the dialogue out there has become more active. Clearly, there's some larger companies talking about divestitures, strategic initiatives, publicly announcing that they're considering alternatives. And so those are all, big signs. At the same time, I would still label it as a cautious environment. I'm not seeing clients cut corners. I'm not seeing them rush into something. I think boards are certainly checking, dotting every I, crossing every T. They're making sure they've done their full diligence. They're making sure that the financing they're going to use is buttoned up, especially as we're heading into an environment where maybe there's some concerns about some of the financial structures that have been used historically.
So this to me is fascinating, the idea that you're seeing something, and it speaks to what people talk about with AI. It looks frothy, but it's not a bubble yet. Yeah. M&A, it looks like it's getting really heated, but it's not a bubble yet. It's not really problematic. dramatic yet. And I just wonder, what's the motivation behind this? Is it because you are seeing the expectation for Fed rate cuts? Is it because there's more policy certainty? Is it just catch up?
Yeah, I think it's a clearer environment in terms of being able to execute on your strategic initiatives. From a government perspective, a regulatory review perspective, we're seeing clients consider transactions that maybe 9, 12 months ago they would not have stepped into because they were concerned about would the government approve this transaction. And so I think there's been a more constructive tone out of the agencies. We've seen them certainly accept remedies much more so in terms of you go into a transaction, you say, well, this might be an issue, but I'll consider these divestitures to satiate the regulators. And I think that's become an environment where you can think about how to constructively do something.
Are there particular industries that you're seeing robust activity? Is this the banking industry? Is this the tech sector in particular? What are the deregulatory areas that are kind of getting juiced by the current landscape?
I mean, as we talked about last time, it's always technology and healthcare. And you look at the Aligned Data Centers deal and Hologic in the past month or a few weeks as two of the largest deals announced year to date. And they highlight those two sectors are always leading the pace. We're seeing some around energy. I think we're seeing a fair bit around financial services. We certainly saw a significant bank deal announced this morning. I think there's more being talked about there. And I think that's an area where if you look at what the regulators from that perspective are considering, they're allowing more of those to come together.
When it comes to the government shutdown, has it been an impediment yet?
Not yet. I think it's noise that's being monitored. On November 5th, it'll become the longest shutdown in history. I think we talked about it last time. The poly markets now are betting. I think it's 52% is going to be November 16th or beyond. I think the vacuum of data is starting to cause some concerns because I think it's becoming more about expectation and estimates as we're seeing what's going on there. We're going to hear a Fed decision later this week, likely to be a rate cut again. And so I think part of it, the longer it goes on, as soon as we start seeing, we joked earlier about how many flights people are on and the fact that you're starting to see some delays, whether it's over the weekend and a lot of the business travel going on. Government employees are starting to miss paychecks. I think more and more of that happening, you're going to see it impact things. And certainly, when you start getting longer, you start impacting GDP going forward. Now, there's always an argument that you recapture it at some point, but that starts to become a concern.
You mentioned the Federal Reserve. How relevant are those rate reductions to the broader story of the acceleration that you've articulated?
Yeah, we talked about it last time. I mean, I think it's helpful. I think it's a good signal. But I also think when you look at the overall environment and what people are thinking about, there was a CEO confidence survey that just came out a couple of weeks ago from the Conference Board, and it was basically flat to the third quarter. It's sort of there's a strong view going forward, but it's certainly cautious, and it's right at the midpoint at about 48, where 50 is kind of the neutral level. But when you looked at what CEOs identified as their number one concerns, it's geopolitical instability at the top of the list. Trade and tariffs was up there, and it dropped to fifth. The other ones that they are concerned about is the uptick in sort of innovations around AI and how they impact their businesses. And so when you look at what CEOs are thinking about, even though they might not be impacted by geopolitical issues somewhere else, they're still thinking about it. It's that noise externally.
Financial conditions just is not the complaint right now. Credit spreads are super tight. Equity markets, we've been talking about it all morning, sky high.
Yeah, right now it seems like there's a window that's open, even though you've got benchmark yields above 4% if you look at the 10-year. I mean, it just sort of goes to this question of what is it that could potentially stymie some of this activity? And does it suggest that maybe this is closer to neutral than anything else because companies are able to adapt to this?
Well, I think the other thing is start noticing what's the commentary is when earnings announcements are being made. You hear mention of the shutdown, but you're not hearing about the significant impact on their businesses. I think you're hearing some caution and saying, well, maybe quote unquote, are we in a bubble, or should we be careful what we're taking on? But they're still proceeding, so they're thinking about it. And I think everybody has a lot of history here and doesn't want to be caught as the party that's jumping in at the last minute when things are going in a difficult direction.
Have you seen the leverage cycle start yet? Have you started to see that come into some of these deals?
A little bit. I think the larger deals are set up in an appropriate fashion, because the largest players in the credit cycle or the credit environment are participating in those transactions. I think when you're hearing some noise in places that have had issues from a financing structure perspective, it's really been some ancillary players that have been in those transactions, and so it's been less of a concern. But Jonathan, I think we're sitting here with corporates probably the healthiest that I've seen them in decades. And again, you go through the financial crisis, you go through COVID. COVID demonstrated there was a resilience in balance sheets and also a resilience in business models. Where you learn to pivot quickly. You learn not to just take one path going forward. You thought about multiple paths, and you were able to make decisions and move your business. You think about earlier this year and how quickly a lot of companies shifted and brought business, back on shore, and you don't hear that tone as much anymore.
Stay with us. More Bloomberg surveillance coming up after this. Terry Haines of Pangaea Policy joined us now for more. Terry, week 4. What's the date circled on your calendar when this gets real?
Oh, I think sometime right before Thanksgiving, I imagine. I've been saying since before the shutdown started that, not only was this politically generated, but that Democrats had the ability to decide when it was finished by merely by agreeing to continue to negotiate on the Obamacare subsidy temporary increase, and so they can do that. And meanwhile, the pain will continue to mount, as you all have talked about, and neither side ultimately is going to want to be the primary blamed for all this. So I think you probably have a truce called sometime before Thanksgiving.
Terry, something interesting happened last week where you had the 2 Democratic senators from Georgia decide to vote with the Republicans and also a Senator Fetterman from Pennsylvania in paying essential workers like air traffic controllers. Are we going to see more of that?
Yeah, I think so. There's going to be a lot of kind of one-shot bills with different constituencies that might not be getting paid and all that. But underneath that, what that shows is a kind of growing disquiet on the Democratic side with the shutdown strategy generally. They're willing to give their leadership the benefit of the doubt, but that's also wearing kind of thin.
We also have elections upcoming November 4th, a big one with the New York City mayor race and also governor elections and Prop 50 in California. Is that going to affect how certain senators show up to vote maybe after the elections take place?
Well, I think it affects how the senators make known to their leadership the willingness to continue. I've been telling people for a couple of weeks now that this was not a political opportunity Republicans sought, but it's one that they'll now seize. What they want on next week in November is to be able to say to the public, look, the Democratic Party is now the party of Mamdani, the new New York City mayor, and you have, I'm being Republicans here, you have Hochul and Jeffries and Schumer all kind of bowing to him, and that's the future of the Democratic Party. And then they also want to point out that the balloon likely gets let out of the Democratic centrists in Virginia and New Jersey. It's a little bit too much for them to hope that the Republicans win in either case. But what they will be able to say is, look, these people barely squeaked through in years where they should have done much better, and they haven't. So the balloon, the air's out of that particular balloon, and what you got is kind of the Mamdani party. And I think folks, frankly, in Midtown Manhattan underestimate just how powerful a message that is in the broader public.
How much does the shutdown really play into local elections like that?
Not much at all, really. There is more in Virginia than in New Jersey because you have a contingent in Northern Virginia. I mean, Virginia's turned a purple state, but it has turned into a tale of two states. If you're in Northern Virginia, you're in heavy government employee territory, and outside of Northern Virginia, you're not. But Northern Virginians are already, by and large, heavily Democratic and motivated to vote for the Democrat Spanberger anyway. So I don't know that it makes a huge difference otherwise, although they're trying to pump up. Less so in New Jersey.
Terry, I'm wondering what you think of Congress being shut down. The Congress hasn't come back to the table so far for another vote since, I believe, September 19th. And this has been a strategy for Majority House Speaker Mike Johnson, where he said, look, it's up to the Senate. The Senate needs to take action. Then Congress can get behind what they do. Do you think that has been a prudent strategy, or one that has really diminished the executive branch of the House of Representatives?
Oh, it's a very prudent strategy. I know I'm aware the New York Times thinks it's not, but by and large it is. He's got to herd cats every day. Johnson does, and giving the cats a playpen in Washington, with a lot of microphones and cameras around him is an opportunity for mischief. So it's much better that he keep them out. It's also much better, frankly, for him that he defends kind of the institution of the House and what the House did on shutdown. And frankly say it's up to the Senate to figure it out. It makes it easier for him on those two levels. So I think it's probably a good idea.
Terry, what is the future of the Democratic Party? Can we just finish on that? Governor Hochul gets booed everywhere she goes. Establishment leaders down in Washington, D.C. reluctant to endorse the guys leading at the polls here in New York City. What's the future of this party?
They're going to have to have I was going to say a cleansing, and that's obviously a bad thought. But the idea is that they've got to come through both generationally and in terms of ideas. They've got to reconnect with people and not just pretend to. They've got to try to figure out how to move people forward. We've had a generation here, and I'm indicting both parties by saying so. We've had a generation here where people have decided to play politics instead of solving problems. The party that gets back to solving problems first and best wins. There's a high perception that the Democratic Party now is the party of rich people and has completely disconnected from its working roots, and the Republicans have come into that hole. Democrats have got to get back to that and get back to figuring out how things ought to run and what they are actually for, or kind of all the Hollywood this or that or the other isn't going to make a difference.
Stay with us. More Bloomberg surveillance coming up after this. The White House naming 5 finalists to replace Fed Chair Jay Powell, including Governor Chris Waller, with the Fed widely expected to cut rates at Wednesday's meeting. Joining us now to discuss is Veronica Clark of Citi. Veronica, good morning.
Good morning.
Rate cut nailed on for Wednesday. Can't seem to find anyone who disagrees with that. How much guidance can they provide beyond Wednesday's meeting?
Yeah, probably not a whole lot. We haven't had any data, of course. I think if anything, the data that we have had, obviously CPI on Friday, should give them a bit more confidence that, inflation is slowing, labor market is weakening, but they probably can't give us a whole lot of guidance right now. We have no data.
How comfortable should we be with the data we have got, which is inflation at 3%?
Yeah. I mean, it's not where the Fed obviously wants to be, but I do think they'll find some encouraging details in that data that we got on Friday. We had particularly soft shelter inflation. I think that will be an encouraging development. We haven't seen a ton of the tariff-related inflation. Maybe more of that is still coming, but I think this is slower details than they should be comfortable with. Yeah.
I thought also the owner's equivalent rent was really interesting. The fact that it came down to the lowest going back to 2021. I was looking at this thinking, okay, well, I can buy this story. And then a couple of people messaged me and say, all right, you numbskull, this is backward-looking data that was done over the past year and is completely lagging. And when you look at current indicators, they show something different. What's your response?
I don't actually think the current indicators show anything that different. It is a very lagging indicator, of course. But when you look at all the forward-leading measures, Zillow new rents, home prices have been falling for a lot of this year. It seems like that kind of trend can continue.
At the same time, you are seeing other points spike upward, in particular some of the good sectors, and you see a lot of companies saying that they're still going to pass along additional price hikes. At what point do you start to look at this and say it's not so clean? even though we already knew it wasn't so clean. It's even more difficult to really discern what's going on.
Yeah, I mean, relative to how we were forecasting the tariff pass-through maybe 6 months ago, though, I think for most people, we have been surprised that we haven't seen more pass-through at this point. And I think that, unfortunately, does speak to consumers just can't handle these big one-time kind of price increases. It has to be spread out over many months, which could give the appearance that, yeah, inflation is maybe a bit sticky, but it's still that softer demand backdrop that means you can't pass on these big price increases all at once.
Doesn't it also mean that corporate America has been resilient in terms of mitigating some of the price hikes?
Yeah.
So what does it mean for next year? Do they start to maybe have to lay people off?
Yeah, I do worry that, the more you can't pass on the price increase to consumers, that is eating at profit margins for longer. We already know that businesses are trying to cut labor costs, and they've been doing that. They're not hiring anyone. But I would worry that you can only not hire people for so long before the next step is layoffs. We don't see the signs of that yet, but that is, I think, still a risk.
We're in this data desert with the 27th day of a government shutdown. We had the inflation on Friday, but that was one and done, according to the White House. How long could the Fed continuously cut rates if we remain in a government shutdown and don't have data? Yeah,
it's getting tricky, obviously, because there is the division among Fed officials, a group of people who maybe don't want to cut anymore at all, and people who want to cut each meeting this year. It is hard, but I think the shutdown itself, if it really is lasting that long, that is a drag on growth in itself.
Except we won't see the data. That's where the risk management argument loses some oxygen, I think, in the next meeting in December. If you don't have the data to convert the hawks on the committee, how are they going to vote? And how are they going to forecast into next year?
I mean, we'll have to deal with the data that we do have. Obviously, we'll have the surveys. ISMs probably get more important. The Fed will probably put more weight maybe than I would on something like ADP employment. But yeah, it is tricky.
Are you seeing sufficient deterioration in the other indicators?
It doesn't seem like we're getting that break yet. We fortunately, probably one of the best data points to have, we are getting claims. We are getting the weekly jobless claims data. We just have to aggregate it ourselves from the states. We have seen continuing claims starting to tick up again. Initial claims are still low, but that's going to be an important one to watch.
Let's sit on initial claims. Does that give you and the team pause that maybe the labour market's not as bad as you and some of the dubs on the committee thinks it is?
Yeah, it is tricky. We're getting into the time of year, which this happened last year also, where there is this residual seasonality pattern in the data where we had the weakness in summer 2024 and then things seem to stabilize. I think that seasonal pattern comes from this lack of hiring. This is a time of year when you're not usually hiring a bunch of people, but you're not laying anyone off either. The issue is when we saw that happen last year, it never got better, right? We just repeated it this summer.
How much does the QT plan really matter, the balance sheet? And there was some flirting with that in some of the recent speeches from Fed Chair Jay Powell, that they were planning on stopping some of the shrinking of their balance sheet. Is that important to understand what the directionality is for them in terms of policy?
Yeah, I think maybe my takeaway from it is just a lesson that the Fed is extra cautious, right? When we started to maybe get to the point where maybe reserves are not so abundant, maybe they're just ample, they're maybe talking about ending it earlier. I don't think they'll announce anything this week. It's maybe end of this year into Q1, but they are extra cautious when it comes to everything.
What's the takeaway from you and Andrew, that you've had an ultra dovish Fed for a long time? You've had inflationary shocks, you have an ongoing inflationary shock, and that the knee-jerk response is to risk manage to the downside in the labor market, regardless of what John was talking about, that 3% inflation rate. How do you understand why the market isn't pricing in a greater degree of inflation longer term?
Yeah, I mean, it maybe speaks to some confidence in the Fed, right? We haven't seen long-run inflation expectations going higher. If we did see that, obviously that's a game changer. But I think the market is taking what we see in the labor market data, and that is not a scenario that creates inflation, right? A weaker labor market.
It's been a huge freak out about the erosion of institutional credibility. It's just when you look at market-based indicators, don't quite see the same thing.
At all. I mean, if you take a look at long-term inflation expectations, they've come down in the 10 years, the cleanest read on that. I just thought it was notable. In an interview in the Financial Times over the weekend, Scott Bessent talked about his strategy. What he said is, we want the most America First policies that are possible without incurring market wrath. And he was saying, unlike most of my predecessors, I have a very healthy skepticism of elite institutions, but I have a healthy regard for the market. And that is very much a focus of us as he goes through crafting policy.
Yeah, and he almost felt vindicated in that interview. He was talking about where the hell is the market risk. He's looking at basically all-time highs highs when it comes to the S&P 500. I also think it's interesting when it comes to the Fed. The president told us we're getting a Christmas gift end of the year. We will have a name by the end of the year of what next year potentially policy path forward will look like.
I think the Treasury Secretary's done a good job of buying time on that issue, just stretching things out, delaying things into year end. There was a feeling at one point in the summer you'd get that decision maybe around September time. It's been pushed out a number of months.
But remember, that's when they were jawboning Mr. Too Late, Jay Powell, and the president had called him. Now that the Fed is cutting, I think it's the Fed that gave the Treasury time to make this process a little bit longer than they were expecting.
Just quickly, Veronica, of the names on the screen, you and the team got a pick yet?
No.
Don't want to go there?
No opinions, yeah.
Too soon.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.